Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Linda Yates, founder and CEO of Mach 49. Linda, could you take a few minutes to share your story and how you got to where you are today?
Terrific. Thank you, Nicolas. I'm the co-founder and CEO of Mach 49. I actually am a native Californian, rare in California these days. But what's interesting about that actually is that I grew up in the Silicon Valley with all the people who founded the venture capital industry. So I've been, frankly, deeply rooted and connected in that world. But most of my professional career has been in the boardrooms and C-suites of the Global 500. So I started in investment banking, corporate finance, and M&A with Smith Barney. From there, I went back to graduate school at Stanford. And out of Stanford, I joined one of the large consulting firms at the time called the Mach Group, which was an amazing place. From the Mach Group, I was actually recruited by two faculty members, a person named Gary Hamill, who was at London Business School, and Professor C.K. Prahalad, who was at the University of Michigan. And for any of you who are students of corporate innovation or who want to be students of corporate innovation, you will remember that they are the two professors who pioneered the field of corporate innovation with the publication of their book, Competing for the Future, back in 1994. That book was one of those game-changing, change the world books in the business world. And they decided that they wanted to found a company that was focused exclusively on corporate innovation. And not strategy, not marketing, not operations improvement, but focusing on corporate innovation. They knew they needed somebody who was bilingual between the Silicon Valley, the startups and the venture capitalists, and the boardrooms and C-suites of the Global 500. And so they also needed somebody who knew how to start a company. So they recruited me to become the founding CEO of a company we called Strategos. Strategos was very, very successful. We were more focused on innovation intervention, if you will. It was still more kind of consulting-like, but we pioneered things like creating new venture plans, doing a new venture fair is what we called it in those days. And so I decided to step down as the CEO of Strategos, and I ended up joining the board of directors of Sybase. And I sat on that board for 10 years until it was sold to SAP, which you will remember was a New York Stock Exchange traded, very strong high technology company. And ultimately, I went on to basically rekindle my roots in Silicon Valley, investing in private companies, sitting on boards, and bridging between the startups and the large companies in the Global 500 until about 7 years ago now. And 7 years ago is when Mach 49 was born. If you look at the history of the Silicon Valley, 55 years ago, about now when it was founded, all of the VCs were actually investing in what we call the dreamers, people who are creating whole new industries. So founded Mach 49 to in essence become the Y Combinator, if you will, for the Global 1000. And that's where we are today. A couple of other interesting notes about me, and I'll talk a little bit more about Mach 49. We are complete eco geeks. So I was blessed to be able to create and build the greenest house in America that we've been sharing all of the results with lots of people around the world. I am a big believer in 21st century education. One quick thing on Mach 49, we focus on two big areas, this disrupting inside out and then disrupting outside in. What that means is we basically do four things. We help large companies launch ventures, build incubators to work ourselves out of a job, and do that on a perpetual basis to build a pipeline and portfolio of new ventures. The third is that we help them do corporate venturing, build world-class CVC funds, or in some cases, like with Shell, we help their investment committee in one of their divisions.
Thank you, Linda. It was great. So you mentioned dreamers and disruptors. Who are the current founders? And maybe you can add a bit more of what was so important about it.
Every large company that people like to say is a dinosaur, they can beat the startups at their own game. They can easily eat the unicorns. You have ideas, you have talent, you have brand, you have resources, you have capital, you have technology, you have customers. I had dinner with the brand new CEO of Peugeot, and he came to me and he said, Linda, I want to prove to Silicon Valley that we are here. You grew up inside the walled garden. You can help me navigate. Tell me, how much money do I have to put in a venture fund? Is it 50 million? Is it 100 million? Is it 150 million? I said, it's this much. He said, what, no money? I said, listen, Silicon Valley doesn't need your money. How many customers do you have? He said 30 million. These are the things that the best CVCs understand is that, and this is exactly what TDK Ventures is doing and what a number of great CVC groups are doing is they realize you have to have that ecosystem. You have to bring all these talent ideas and brand to the table. But what we say to people is, listen, there's no reason Marriott could not have created Airbnb. Blockbuster had 3 chances to buy Netflix. There's no law of physics that says Uber could not have come out of Toyota. And the financial services guys are wringing their hands saying Jamie Dimon at JP Morgan wrote a letter to his shareholders 2 years in a row saying that what keeps him up at night is that the Silicon Valley is coming and they all want to eat my lunch. There's no reason any of them couldn't have created Stripe, which today is a $32 billion valuation. And that's the issue about dreamers and disruptors, which is there's no reason that large companies cannot disrupt themselves either from the inside out or the outside in. You have way more to bring to the table than any 25-year-old startup. You'd also have inertia, antibodies, and orthodoxies that have to be overcome.
I think that's a really great message for those who are listening, who are thinking about corporate venturing. It really is meaningful and it can really change what can happen to the mothership and how innovation can happen. What are the thoughts about reducing talent risk so that those speedboats have the right pilots?
When we work with clients, we have 5 preconditions for success or we won't work with them. And the first 2 are you have to have a full-time team. And on that team, you have to have a CEO candidate or a business owner candidate. It's the same thing, by the way, when we work with CVCs. The interesting thing about when we work with CVCs, though, is that we say you need someone who knows the mothership, not somebody who knows venture capital. Because of my point about you have to be able to bring the capability of the mothership to benefit your ventures. And Nicola, you can talk about lots of ways that you guys have brought the capability of TDK Ventures to benefit your startups. But the issue with talent is there's 2 sides to that coin. So number 1 is there's a ton of internal entrepreneurs inside every large company. And the way to basically recruit and retain those stars is to basically give them an opportunity to build ventures and to work on a portfolio. That's why I believe most large companies should become Berkshire Hathaway, because it's a better opportunity for people. In terms of talent risk, you've got talent risk inside, which is you're going to lose people who are talented because capital is global and they're going to have TDK Ventures invest in them outside. So it's one way to actually avoid losing talent if you build an incubator or you build CVCs. The flip side on talent risk is you may not have all the people that you need. When we tell clients that you have to have that full-time team and a CEO candidate, we tell that CEO candidate, you may not be the CEO of the venture in the end, because if you're a bunch of investment bankers and you build a digital platform and you don't have any experience, or your venture is about building a really cool digital platform to offer a service, we're going to have to go outside to get that talent risk. When we go outside, and even when we're inside, we truly believe in the Silicon Valley model of sharing in the upside. So there are performance metrics that are attached both to the CVCs, and they may not be a traditional model in many of the CVCs case, but there are performance metrics built in. Same thing on the venture building. We put in the concept of phantom shares to make sure that we can recruit people from the outside if we don't have enough of the talent we need to basically ensure that the pilots are going to be successful.
I really like the way you describe it, because not doing something potentially means you're going to lose your best talent. So it's not about just the talent risk of doing it, but actually not doing it. I want to double click on something which is very tactical, but would be very useful for people to know about it, is a phantom shares. Because most people don't know, and I think that's actually a really important element of rewarding people taking some level of risk and having a level of upsides.
Yeah. So I think there's 4 levels of people that need to be compensated when you're doing venture building or venture investing from a mothership standpoint. Let's say we're disrupting inside out, we're building a venture. If you're building a venture on the outside, it's easy. You just set up a cap table. It's just a normal thing. You just set it up in the same way. Yeah. What you are trying to do with the phantom shares is mimic that cap table, but on the inside. So it's not real shares in the sense of that if you launch a venture inside TDK, you're getting TDK shares. But the nice thing about it is that those phantom shares can be evergreened, as opposed to an IPO where you sell your shares or the stock price is determined externally. You have control over what you earn based on your performance. So it's very tied to performance in that way. But if you're the CEO and you still have X percentage, you put a pool aside. Now, it may not be quite as big a pool as you might find with an external venture because you're not taking as much risk. You're getting all your money from the mothership. You're not having to go hat in hand to the venture capitalists every 3 months to go get another round of funding. So there's a lot of benefits to launching, and you have hopefully 30 million customers that you get to go to and run your pilots with. So there's less risk, so there may be less upside. The other thing that's really cool about another opportunity you have to reward people, and we did this with one of the companies, which is a lot of times venture building is people talk about 25-year-old CEOs, right? And a lot of times there are a lot of entrepreneurs who are in their 40s, their 50s, their 60s. They're very, very strong, super talented, super experienced, but they can't take the risk that a 25-year-old with no family and no debt and no college tuition to pay. The beauty of doing what we're doing is we allow people who are entrepreneurial, either in the form of the CVC or in the form of building an incubator or venture building, they can actually look and toggle their risk. So we had one company where the young guy in the company who had no family, he basically took nothing in terms of the traditional base and bonus and toggled way up on the equity. But we had another person in their mid 50s who had kids in school who couldn't afford the risk, and he just continued on with his base plus bonus. So he wasn't going to get the upside, but he was protected on the downside to a certain extent. Whereas the other guy was going to make more than everybody else, but he was great because he helped us manage the cash burn, because he took very little traditional salary and bonus. So that's one set of people you compensate. There's a range of ways that you're compensating the CVCs. Obviously, you want them to share in the upside, and there's multiple models for that. And then even with an incubator team, if the incubator team is pumping out multiple ventures, then we typically give them a percentage or two of each of the ventures in terms of phantom shares, because they have become the Mach 49 inside, and they're helping to launch these things.
Which makes a lot of sense. I really like everything you've said. You mentioned 5 criteria to work with a company.
Yeah.
Of course, a full-time team and a CEO candidate with mothership knowledge. And they say, what about the other 3?
Well, I talked about those 2 because Kumi asked the question about talent. The other 3 are access to funding, because when we build ventures with companies, and it's the same thing for CVC, the issue is that when we are doing venture building with a company, we are not here to do a theoretical abstract exercise. We are 100% focused on execution. So in 12 weeks, that venture has a daily stand-up, nightly sit-down, they have a logo, they have a website, they are a real startup. So by the end of that 12 weeks, we have a very robust and rigorous business plan, and we have pilots ready to go. We just finished one with one of our large industrial clients, 24 customers saying, hey, at the end of just 12 weeks, if you guys continue on into pilots, I want to be a pilot. And so that means as a mothership, as a senior, the new venture board, the kind of internal VCs do not have 3 months to go find that $500,000 or whatever we need to go run those pilots. And so access to seed funding is very important. Same thing on the CVC side. We teach the CVCs, look, for every $1 in initial investment, there's $3 follow on if you want to exercise your pro rata. So you've got to be thinking, working from the future backwards in terms of the funding. The 4th thing is an engaged new venture board. And what we mean by that is those senior executives who become the internal venture capitalists who will do 4 things. They will make the fund, no fund decision. They can provide access to the customers' channels and markets that give you the competitive advantage over any well-funded startup. They can provide access to those core competencies, assets, and capabilities. And then ultimately they can remove the friction that can sometimes occur. Get that procurement person. We were working with a big pet food company, and they were doing an integrated hardware software product, super cool, but they didn't have a pre-approved hardware prototyper on their procurement list. How long does that take? It needed to take 2 weeks, not 12 weeks, because we only have 12 weeks to do the whole thing. And so the new venture board is very, very critical. When we say engaged, they don't need to do a ton of time, but there are some things that we ask them to engage in. And then the 5th thing is an early consideration of what you're going to do with those ventures. Are you going to spin them out? Because if you're going to spin them out to take, and most of our clients for the internal venture building they're doing don't want to spin them out because they want to be perceived as growth stocks, not value stocks. So they want to retain the value. But if they want to spin them out, you got to prepare them differently than you might if you're spinning them back in. So there's spin out, there's spin into an existing business unit. And we say to people, listen, if you think about the spectrum of new venture creation from ideate to incubate to accelerate to scale, that we recommend if you're running an incubator that you keep those ventures with you in the incubator through the first phase of accelerate when they're launched and in the market. We call that the build to learn and validate phase, and into the early build to automate and standardize, because if you throw it back into a business unit, it will get crushed for sure. And then the third option is a wholly owned subsidiary. So most of our clients actually will end up doing a wholly owned subsidiary, but based on the decisions you make at what you think working from the future backwards you're going to do with your ventures on Accelerate, that will determine, do I need to create that internal innovation ecosystem, those new venture advocates? It'll inform some of the things you need to do on the mothership side to ensure that these ventures reach escape velocity.
That's very nice. And I remember at the very beginning, you talk about you do incubators on a perpetual basis, and you talk about the spin out and the spin in. Have you seen examples that work really well where some are spin in and some are spin out?
Yeah, there's two main reasons people will spin them out. Number one is it's a big infrastructure play or a big capital intensive play, and they want to share the risk with other people's money. So that's one reason, is they want to share the risk. Could be other CVCs, could be VCs, could be family offices. And then in other cases, it's because they bring certain superpowers to the venture, but that venture requires additional superpowers to actually be successful and thrive. And so that's the other time that you might spin them out, is when you're saying, hey, this might be an interesting joint venture partner, or might be an ecosystem play, and we want to bring these other people to the table. And to do that, then those people obviously need to share in the upside, and to share in the upside, you need to spin them out and have a separate entity. So we do see them occasionally. We do see people who will either do a spin in or a spin out. Most of our clients don't spin in to an existing business unit right away, because if you remember, business units are for two reasons. Number one, often it might be in the middle of the budget year, and by the way, they didn't budget to basically launch a new venture. Same thing for CVCs. If you basically bring to one of your business units, hey, I want you to do a pilot, but then you tell them they have to pay for the pilot, a lot of times they'll be like, look, I can't do that. I don't have the budget for it. So you have to be creative about where the money is going to come from to basically to pay for that pilot. And then the other thing around the business units is that often their metrics, the KPIs of a core and legacy business are not the same metrics as what a CVC should have or what a new venture should have. The metrics that a business unit lives by, those KPIs are very different than what you want from a venture. You want a venture reinvesting, not looking for short-term profit.
Very nice. And I will double click on the spin-in, because I think you're saying this is what's most common. What would be the smart KPIs for creating the context for successful spin-in?
There's 5 swim lanes when you're looking at a venture. There's product market fit. There's the building the product. There's looking for that, right? There's also then tests you're going to run around the go-to-market. Are they using inside sales? Are they using digital? Are they using field sales? What's the mechanism that you're going to use to go to market? The third is the business model. How are you going to make money? What are the sources of revenue? And you need to design tests on willingness to pay and how you're going to go after that revenue. The fourth swim lane is around operations. It may be great. You have so much pain. There is a totally feasible product to build, but guess what? It's so expensive to deliver that product that the unit economics don't work and they don't scale. And so you can't make any money. And as a large company, you've got to be able to move the needle for a multi-billion-dollar company. And then the fifth swim lane is really about growing the team and making sure, back to that talent conversation, that you've got the right people in the right place and the right team.
Very nice. And now if we look at KPIs for the audience who wants to do an incubator inside their own company, what would be their KPIs to make sure that what you've just described, the blueprint, is not just protected and nurtured, but actually does pop up quite a few successes? It won't be successful every time, but actually, like you said, failing early is okay. What's not okay is to go for a long time and then you end up with no market. So what would be the KPIs you would recommend for people who are in charge of the incubation?
The Financial Times just created a new innovation media platform that anybody who's doing a CVC or an incubator should be looking at. It's really quite good. It's called Sifted. And they actually just put out some very scary statistics on corporate accelerators. So the average venture capitalist, the success rate of their ventures is about 11%. If a venture goes through like a Y Combinator or a Techstars or a 500 startups, that tends to be a higher success rate, maybe about 12%. Corporate incubators and accelerators actually are only about 8% success rate. And part of the reason is because if you look at 500 startups, or you look at any of the classic incubators, they don't need as big of a hit rate as a large scale incubator inside of a large company because they have limited partners. If they have 2 startups that do really well, that returns the fund, their limited partners are happy. They can afford a lower percentage success rate. No incubator can survive that success rate. They certainly can't survive an 8% success rate. And the reason why most of them fail is threefold. Number one is they look at a 500 and they say, it's all about mentors and money. Well, that works for a lot of the classic incubators, but that doesn't work for a large company. So they need methodology. They need a repeatable, scalable model. That's number one. And if you do that, then your hit rate will be higher. So the incubator, just like for us, we're only as good as the last venture we launch into the market. We have about a 90% success rate of ventures in the market, generating revenue, getting acquired, et cetera. But it's because we're super anal about that. So if there's no customer pain or the product isn't feasible or you can't make money. So number one is that the KPIs for the incubator need to be around, are you screening your ventures, doing a good portfolio review of the ventures you're going to put in and choose to incubate in the first place? So that's the first place that you need good KPIs. Then it's, are you basically using a repeatable and scalable model so that you don't get garbage in, garbage out? And that on the back end, you're doing very robust and rigorous business and execution plans. And then your primary KPI is going to be around the success of your ventures in the market. And you should be, frankly, no less than a 50% success rate if you have been disciplined about the incubation process. Even into Accelerate, you may kill it then. But again, you're trying to remove the greatest amount of risk on the least amount of capital. So you should not be over investing in these ventures early on.
So let me challenge a bit. If it's 90%, is that not playing it too safe?
No, because you need to kill ventures. So we don't want to have 100% success. I don't think it's possible if you look at the history of Silicon Valley. So for us, what's really important about that 90% is that's not 90% coming out of Incubate. We don't count it when it finishes its business and execution plan. We only count it if it's basically already a launched venture that's funded, that's actually got pilots and customers demonstrating a willingness to pay. So that's not too safe there, considering that everybody else is 8% or 10% or 12%. I think 50% is realistic. I would say they should do 90%. And I think the mothership plays such a big role that if the mothership isn't disciplined and doesn't lean in, and it doesn't basically figure out how to help these things reach escape velocity, then it's going to be hard for that incubator to achieve that kind of results without that. So there's a little bit of a hedging of bets on my part for the benefit of the incubator, because their mothership has to basically behave.
Very nice. Because you see so many CVCs, I think you're a really good person to answer this question. Should a CVC be part of the corporation, a department, or should it be set up as a separate entity, arm's length?
Okay, so it should be separate as a separate entity, especially at the beginning. Now you can evolve to this, but at the very beginning, the whole value you bring to the network and the ecosystem that you want to be considered an A player in is the mothership. It's the assets, core competencies, capabilities, channels, customers. What we see is that too many people too fast try to basically really separate themselves and just become a financial engine as opposed to a strategically relevant reason for the mothership. If you completely disassociate yourself with your mothership, then you're now competing with Benchmark, with Foundation, with Kleiner Perkins, with Sequoia. It's very hard to do that when they've been doing it for 50 years. They've been in business doing this a very long time. Very few other places in the world have been able to recreate Silicon Valley for this reason. AT&T never invested a dime in a company. All they focused on was strategic partnering, and they did it very well.
Thank you, Linda. It was really nice, inspiring, and Amazing answers. Thank you so much.
Always fun. All right, everybody. Take
Thank
care.
you.